Thank you all for your time today. I'm the chairman of Calima Energy. I've been involved with Calima for a number of years now, and I have to say where we're sitting today, we're in the strongest position we've been in this company. I think if we can move to slide, starts with the new Calima. So as I said, we've built a position in Canada. We have three major assets. One, the Montney, which is a large wet gas play in northern BC. And then we have two other assets in the Brooks and Thorsby, which are to the north and south of Calgary. We're focused on Canada because it's a tier 1 jurisdiction. We're focused on Canada because it's got a history of oil and gas production. And we're focused on Canada because we can find some of the best people to work with. So where we're sitting today is we have a tremendous asset base that we can generate significant free cash flow and that we can ramp ourselves up with a rising energy price. The assets that we've acquired through the transaction with Blackspur, which was completed probably about a month ago when we raised $38 million, they're tier 1 assets. They break even at $26 a barrel. They've got strong torque, so when the oil price runs, we make bucket loads of money. And with the oil price today at $68 a barrel, our business that we've acquired together with Blackspur is making significant free cash flow, and it will continue to make a lot of free cash flow. However, on the downside, the oil price needs to fall to $26 a barrel for us to actually lose money or shut in operations. So I'm a great believer that the oil price is going to go for a run. It already has since we bought this business, and I'm actually looking at oil prices hitting over $100 a barrel, which is what Goldman Sachs and others have predicted. And when oil prices hit those levels, this business is going to be valued at 5, 6, 7, 8 times multiples where we're sitting today. One of the things you'll see in this presentation, we've modeled done our analysis at $60 WTI. When we first agreed to buy Blackspur, the WTI price in the US was $45, and we did sensitivities at 45, 50, and 55. Since we bought the business, the oil price has rallied. We've done sensitivities at $50, $60, and $70. Now with oil at $68 a barrel and going north, we're going to be doing our sensitivities at $60, $70, and $80. So you'll see some real upside in this business. The other thing that we love about Canada is that it's got a history of oil and gas production. They've always been competitive, they've always been low cost, and they've been producing oil and gas for over 100 years. So one of the things we like about it is the industry, the people, the infrastructure is all there. They understand oil and gas, and we're in a tier 1 jurisdiction. And I think most importantly for us, we've got upside to the LNG story through our Montney assets. Shell is building a very large LNG export facility on the BC coastline in Kitimat, and that has changed the whole dynamics of the Montney. We'll go to the next slide, thank you. Just to give you a corporate snapshot, we're currently trading on the ASX under the code CE1. We have a lot of shares in issue. We've got 10.3 billion shares in issue, and that's because we raised $38 million at 0.7% recently. And there's a lot of questions, why did we do that? Why did we suffer such dilution to raise that money? We did it because, one, we were buying some of the best assets around, and two, we fundamentally believed that the oil price was going to rally strongly. And on that basis, we felt that it was worth paying extra for a tier 1 asset that would always give us a hedge on the downside, but give us tremendous leverage and torque on the upside. At the moment, our shares are trading at 0.8, 0.9, market cap of about $80, $90 million. But as I said, I can see that rallying very strongly over the next few months. We've got a bit of stock overhang at 1. Some of the traders that took the placement at 0.7 are wanting to sell it at 1. So we've got a large line of stock on the offer at 0.1, but that will be cleared out as the oil price continues to rally. I think a reflection of our business is we have a line of credit from the National Bank of Canada. We have a $25 million line of credit that allows us to draw down funding to expand our production base. And you'll see, you probably would have read over the last few days that we've actually announced a 3-well drilling program. We'll be using our line of credit for that. And that line of credit is at a 4% cost of funds. So it's no hedge money at 10 or 12%. It's a line of credit at 4% from a quality Canadian bank that understands oil and gas and understands our business and the strength of our assets. At the moment, that line of credit is actually drawn to around $12 or $13 million, and that will peak sometimes at 18, 20 and come back to 12 or 13. But the objective is in 2022 to pay off all our credit facilities. One of the things our business will do is generate tremendous cash flow. So even at 3,000 barrels a day, our break even, as I said, is $26. Our OPEX, so to produce a barrel of oil is less than $10 Canadian. And then the difference between the 10 and the 26 is royalties and other taxes. But we have tremendous leverage, as I said, to the upside. We have reserves. We're not an exploration play. We're not out there going to announce that we're going to drill a well and we're going to bring the rig to site and then we've actually spudded the well, and then we're at 1,200 meters. And so we're a development company developing proven and probable reserves. So our 2P reserve numbers are 22 odd million barrels. So we're not as sexy as some of the others, but we will be generating tremendous cash flow, and we will have the ability to pay dividends, distributions, share buybacks over the coming 12 months. And on the Montney, we have actually a contingent resource of just under 200 million barrels, which is gas weighted, where our Brooks and Thorsby assets are oil weighted. Next slide, please. As I said, look, I'm excited about this. I've put in a lot of the family money into this. A lot of my friends and family took placements at 0.7 and so forth. And I saw a couple of people listening today are shareholders, but we've got a very de-risked asset base. We've got the assets that we bought from Blackspur. They had spent over $200 million on these assets. They got caught out in sort of a perfect storm during COVID when the oil price fell. Banks were reducing their risk to the smaller junior oil and gas sector, and we took a bit of a punt. When we contracted to buy this business in November last year, the oil price was $45. In January, we put down $1 million non-refundable deposit to buy this business. We fundamentally believed that this business was so good and so strong, we were really willing to risk $1 million, and we've been proven right so far. As I said, the business generates tremendous free cash flow. We've got exposure to the LNG industry. Many of you may recall in Queensland what happened when they built 3 LNG export facilities. Sunshine Gas, Queensland Gas, Arrow went through the roof. We went into Canada years ago and drilled 3 wells, spent $50 million. We got the timing wrong because of the unconventional growth of the unconventional industry in the US, sent gas prices from $3.50, $4 an M down to 50 cents. We still have that LNG, that Montney asset, which will deliver some real value going forward because gas prices today are above $3. We've got great netbacks, as I said. We've got, and most importantly here, we have a really skilled management team. When we bought the assets, we bought the assets because of the quality of the management team. The team in Canada is first rate. They know their business, they're committed to it, and they actually set it up from scratch. Next slide, please. Where are we today? We've got a couple of strategies that we're going to deliver on. We're currently producing around 3,000 barrels a day. The release the other day talked about 2,818. We've done some workovers, tied it up, improved some of the productivity from the wells. We're doing 3,000 barrels a day now. The objective is to get to 5,500 barrels a day. And we've told the market initially we would like to achieve that by the end of 2022. We will achieve 5,500 barrels a day within 12 months, and hopefully we'll achieve 5,500 barrels a day within 6 to 8 months. At oil prices at $68 a barrel, we can drill a well and get our money back within 6 months. So we can recycle our capital over and over again. Oil price runs to $100 a barrel, we will recycle our capital in less than 3 months. We have a business that generates tremendous cash flow. In the longer term, we're going to look at developing the Montney asset together with a partner. That we've got facilities and infrastructure. We've got a plant and infrastructure there that would cost us $80 million to replace. It's on care and maintenance at the moment, but that's got capacity for 11,000 barrels a day of oil. And on the upside, we have reserve growth that we can look at in terms of our existing acreage. We obviously have the Montney, and you'll see that we're actually going to do bolt-on acquisitions to consolidate our position. Next slide, please. Look, valuation, we're trading at 3.5 times EV to 2P multiples. It's at a substantial discount to our Canadian and Aussie peers. The Canadian peers have actually rallied. They're probably trading at an average of 7 and 8 times now. Gear, Surge, Cardinal. These are companies also that have an oil weighting like us, not a gas weighting, because as you may know, despite people talking about barrels of oil equivalent of production, there's a huge revenue differential between that. So normally when you convert oil or gas to oil, you do it at a 6-to-1 ratio. So But however, the price differential between oil and gas is currently gas is $3 an M, oil price is 68. The price differential is about 22 times, 21 times. Yet the conversion ratios are 6 times. So always look when you're investing in oil and gas companies at the barrel of oil equivalent and look at the gas component of that barrel of oil equivalent versus the oil component. You want a company that's oil weighted, not gas weighted. And we are oil weighted. We are 70% oil, which means that 70% of our sales of barrel oil equivalent are generating $60, $65, $68 a barrel WTI. Next slide, please. This slide kind of says it all. As I said, I mentioned earlier, this is the sensitivities at $50, $60 and $70 WTI. We're currently, all our models that we're using at the moment are $60 WTI. Currently at 3,000 barrels a day of production, we would generate $25 million of EBITDA on an annual basis. At 5,500 barrels a day, as you'll see in the green section, we generate $58 million EBITDA. Beauty of the oil business is once you've drilled the wells, once you've paid off your capital, and everything other than your royalties and OPEX is free cash flow and money in the bank. So we're not going out there. We don't have to keep digging up iron ore, crush it, transport and so forth. Once you've got your well drilled, once you've got your downhole pump and it's connected to infrastructure, the leverage and the free cash flow is just absolutely fabulous. Oil price is getting up to $68 at $70 WTI. This business, when we're generating 5,500 barrels a day, will generate $73 million Canadian of EBITDA. So again, really leveraged. Our market cap, as I said, is around 80 to 90 million today, depending on where the share price trades. Next slide, please. As I said, management board, reason we bought this business and merged with Blackspur was the people, Jordan, Braden, Mark Freeman, the guys in Canada, Mike Dobovich and so forth, first-class team. The business is being run from Canada. We in Australia are the capital markets arm. We provide the compliance, the ASX listing and so forth. We have a first-class Canadian team. We're not trying to run this business from Australia and tell the Canadians how to run their operations. We are running the capital markets, we are running the accounts, the finance, but they're running the business. And they have delivered on this time and time again. We're putting out an operations update next Wednesday, Thursday, and you'll see the revenue we've generated for the first month, and you'll see the EBITDA for the first month of ownership. And I think you'll all be quite impressed. Next slide, please. I know I only have 2 minutes left and I get a bit excited. This is the Brooks and the Thorsby. As I mentioned, Blackspur spent over $200 million building out their infrastructure and their asset base over a 7-year period. They got caught in the perfect storm. That was to our benefit and also to theirs because many of the Blackspur shareholders took Calima shares as part of the transaction. So many of the original Blackspur shareholders, including management, are shareholders today at Calima. Next slide. Green areas here are our license areas. You can see the facilities and infrastructure. I think the key here is on the Brooks, we have 11.6 million barrels of 2P reserves. And most importantly, we have 35 booked locations that we can go and drill and bring into production very quickly. There's also 147 locations that have been identified that still need further work to be done, but 35. So we're drilling 3 wells now. We're going to drill another 3 later on. We're virtually going to drill 1 well a month for the next 24 months. And that is to increase the production base to 5,000 barrels a day and further. Next well, thank you. Slide, thank you. Thorsby again, 10 million barrels of 2P reserves. We have infrastructure, facilities, large leasing area. We're going to be drilling Thorsby wells. I think the intention is we'll start commencing those wells in July. Next slide. Montney. The Montney is a world-class basin. Canada's actually got the 3rd largest reserves in the world. Marcellus, Eagle Ford, Bakken, you'll all know in the US. The Montney used to deliver a majority of the hydrocarbon molecules to the US years and years ago. However, when the US became self-sufficient, the Montney became irrelevant, or not as relevant as it is today. Gas prices are going up. We're going to be delivering gas again to the LNG industry and into the US distribution system because the acreage is already connected to the pipeline. Next slide. Where we are today is we're a cash flow generating company with operations in Canada, with a first-class management team and a first-class jurisdiction, and we will be delivering results that will, I think, impress every shareholder over the next 24 months. Thank you.